Welcome to TaxLawGH and welcome to our video that focuses on the discussion of taxation of income from a business focuses on the taxation of company income taxes. The last thing we did in part 1 of this series was to look at the residual deduction rule, and you remember we ended with the concept of an expense having to be wholly, exclusively, and necessarily incurred for it to be deductible for the purposes of arriving at the assessable income or the chargeable income from a business. So the next thing we need to look at is the concept of interest or the element of interest. We are saying for the purpose of the residual deduction rule, which says that it must be wholly, exclusively, necessarily incurred, interest incurred by a person during a year of assessment under a debt obligation of the person is incurred in the production of income to the extent that where the debt obligation was incurred in borrowing money, that money is used during the year or was used to acquire an asset that is used during the year in production of the income, and the debt obligation was incurred in the production of income in any other case. What this essentially means is that for interest to be deductible, that interest should have been used or that interest should have been incurred on money that was borrowed under a debt obligation, and that borrowed money was either used in the business to generate the business income, or that money was used to acquire an asset which was used in the business to generate income. So what we are saying here is that for interest, it's important to remember that it must be on a debt obligation that relates to generating the income of the business, or it was used to acquire an asset that was used in the course of generating business income. Remember this. Now, interest is also subject to something called the thin capitalization rules, which we'll look at in subsequent advanced issues videos. But for now, just remember that interest is deductible to the extent that it relates to a debt obligation that is either used to generate business income or that is used to acquire an asset that is used to generate the income of the person for the year. Remember, this is very, very important. Then let's look at the concept of trading stock. I've already mentioned that at a basic level, this is what you know as inventory in your accounting studies. We are saying the person who is ascertaining the income of that person or of another person from the business shall deduct, in respect of trading stock, the allowance calculated below. The allowance is calculated by adding something and deducting something. So we are saying, what do you add? You add the opening value of the trading stock of the business for the year to the expenses incurred by the person during the year and included in the cost of trading stock, and you deduct from the sum above the closing value of the trading stock for the year. Those who have an accounting background, you might probably remember that to find cost of sales, what do? We say it's opening inventory, or what some people say opening stock. You add purchases, then you less closing stock or closing inventory at a very simplistic level. It is that same concept that is being used here to find the allowance that is deductible as trading stock. Then the direct mirror image from accounting is you pick the opening value of trading stock from the tax perspective, you add the cost of any expenses incurred to purchase or to acquire or to construct if you're in the manufacturing business, or to make your own trading stock. So opening purchase, opening inventory, opening trading stock, you add the cost of adding new trading stock. Then you less deduct the closing value of trading stock. Then we are saying here that the opening value of trading stock of the business is the closing value of the previous year of assessment. So if you ended last year with $1,000 worth of trading stock, then you bring that balance forward to this year, and that becomes the opening balance at the start of 2021, or the start of the next year, in simplistic terms, right? If that is the opening value, what is the closing value? This is where something is different from what the accounting students probably already know. We are saying here that the closing value of trading stock of a business is the lower of two things. It's the lower of cost of the trading stock of the business at the end of the year, or the market value of the trading stock at the end of the year. So here's the lower of cost and market value. If you are an accountant, you probably know of the accounting standards or the International Financial Reporting Standard IAS 2 on inventory, which says that inventory should be measured at the lower of cost and net realizable value. Remember that under tax, it is not the lower of cost and net realizable value, it's the lower of cost and market value. In accounting, your net realizable value is technically your market value less realization cost, or how much it will cost you to sell the asset. But in tax, remember, the closing value of inventory is the lower of cost and market value. Very important to remember. We are saying here that note that where the closing value of trading stock is determined in accordance with the market value, then the person is required to reset the trading stock to that value. What we are saying here is that in any case where you use the market value to determine your trading stock value, then you need to reset the cost to that market value. In other words, anytime you are carrying the inventory for more than it is really worth, then you need to write down. So an accountant would have called it an inventory write down. You really do not impair inventory per se, right? So you call it an inventory write, as an expense you make to write down inventory. So if the cost is higher than the market value, it means the current value in your books is higher than how much you can realize it for on the market. In that case, you need to write it down from the cost to market value. And that is what the law is calling here. You need to reset the trading stock to that value. And that reset will be an extra expense in the income statement. Now that we know trading stock, let's look at repairs and improvements. Businesses incur expenses to repair different assets, to improve different capital assets and all of that. We are saying a person who is calculating the income of a person shall deduct from their income any expense that is incurred by that person for the repair or improvement of a depreciable asset. Remember, depreciable assets are generally assets that are subject to the rules of capital allowance, which we saw in the series of videos on the capital allowance. So any expense you incur to either repair or improve a depreciable asset is a repair or improvement expense. We are saying that you are allowed to deduct any expense where it meets the requirement of the residual deduction rule, which says that the expense must be wholly, exclusively, and necessarily incurred. We are saying irrespective of whether the expense is of a capital nature. So remember that the general rule says that we do not ordinarily allow deductions of capital items. But here, where it is a repair and improvement expenditure, we disregard that and we grant a deduction for capital items. But there is a rule that must be followed when it comes to repairs and improvement expenditure. We are saying despite the above that says you can deduct repairs and improvement expenditure that is wholly, exclusively, and necessarily incurred, a deduction granted for a year of assessment with respect to a depreciable asset in a particular pool of depreciable assets shall not exceed 5% of the written down value of the pool at the end of the year. So you have been given a limit as to how much repairs and improvement can be deducted for a depreciable asset. And remember, all depreciable assets belong to a pool, right? So we are saying that, and this deduction is allowed in the order in which the expense was incurred. We are saying also that any excess expense for which the deduction is not allowed, or for which a deduction is disallowed as a result of the 5% rule above, will be added to the depreciation basis of the pool to which it relates, and capital allowance will be granted on that accordingly. Let me give you a numerical example. Let's say Company A has a pool of assets. So let's even use class 1 or pool 1, which relates to computers and data handling equipment together with their peripheral devices. If you watch the video on capital allowances, you know that class 1 or pool 1 attracts a 40% capital allowance rate using the reducing balance method. Now, if you are using a class 1 asset, let's say you decide to repair your MacBook Pro, right? You take your MacBook for repairs. Now, they tell you that it will cost you 6,000 cedis to repair the MacBook. So the expense is 6,000. No problem. Then you come back and ask yourself, all things being equal, you should have been able to deduct the 6,000 expense easily, right? But you need to check this rule. If it is a repairs and improvement expenditure, it cannot exceed 5% of the written down value of the pool at the end of the year. So let's use numbers. Let's assume that when you pick the whole pool 1 or the whole class 1 pool of assets, the written down value of the pool at the end of the year is 5,000 cedis. Don't forget that written down value, if you watch the capital allowance video, is the closing value of the pool, which will essentially be the written down value brought forward of the pool. You add any additions during the year to the pool, then you reduce or you deduct the pool balance by any consideration received for assets that were realized or disposed of during the year. So we are saying that at the end of the year, whatever your written down value is, in this case, I'm saying it is $5,000. Let's make it simple. So let's say 5% of the written down value of the pool I'm talking about comes to 5,000 cedis. So the written down value of the pool, 5% of it is 5,000 cedis. I've computed that on the side. Then I incur an expense which is 6,000 cedis. What the law is saying is that any repair and improvement expenditure cannot exceed 5% of the written down value of the pool. If it does exceed, then I'll only grant the 5% portion as a repair and improvement expenditure, which will be deducted in arriving at my chargeable income for the year. Any excess expenditure above that 5% will be added back to the pool, in this case pool 1, and then capital allowance granted on it. So let me give you an example. This same example, I incur a repair expense of 6,000 cedis. 5% of the pool 1, which contains my MacBook, or which includes my MacBook. 5% of the pool balance at the end of the year comes to 5,000. It means I've incurred 1,000 cedis in excess of the 5% limit. What the law will do is, out of the 6,000, you'll be given a deduction for the 5,000 cedis portion because it's within the 5% threshold. Then the extra 1,000 cedis above the 5% will be added again to pool 1, and then we'll recompute capital allowance for pool 1 for the year. So this is kind of done on an iterative basis where because you are required to use the year-end balance of the pool and you would have already done additions for the year, it's important to make sure that whatever computation you do uses indeed the year-end balance and then adds the excess and recomputes capital allowance in a way that is simplistic. Remember, we are saying here too that the rule is 5%. It is written down value of the pool at the end of the year. Compute that 5%. Compare how much repair and improvement you've incurred. If it is more than the 5%, only grant up to the 5%. Then the excess will be added to the pool as if you have acquired an asset. Even though it's still an expense, we treat it as if you've acquired an asset to the extent of the excess above 5%, and we grant you capital allowance on that portion. Then let's look at research and development expenditure or expenses. So we are saying a research and development expenditure that meets the residual deduction rule, which is wholly, exclusively, and necessarily incurred, may be deducted, irrespective of whether or not it's of a capital nature. So research and development includes an expense incurred by a person in the process of developing the business of that person and improving business products or processes. And it excludes an expense incurred that is otherwise included in the cost of an asset used in the process. Remember, this is very different from the principle in accounting. Sorry if you're not an accounting student, but let me just mention for the accountants to have something to contrast this principle with. In accounting, if you are reading IAS 38 on intangible assets, you'd have learned the principle of research and development, which says that all research expenditure should be expensed and development expenditure will only be capitalized if it meets certain criteria. It's probable that it will bring in future benefits, there's intention to complete, you have resources available and all of that, right? Here we are saying that in tax, Research and development expenditure that meets the wholly exclusive necessarily rule may be deducted whether or not it's of capital nature. End of story. So we have a more simplistic rule in tax as opposed to what the accounting standards provide. So remember this, it's very important. Then capital allowances. This has been treated in a lot more detail in the video on capital allowances, but just know that the law is saying that for the purpose of arriving at a person's income from a business, they can deduct capital allowances, and this will be granted on any depreciable assets they've owned and used during the year and calculated in respect of the third schedule. There's a full series of videos on this, so watch that if you haven't already. Next thing we will look at is losses on realization of assets and liabilities. So we're saying a person who is ascertaining the income of that person or of another person from an investment or business for a year of assessment shall deduct 1. Any loss the person makes from realizing assets may be deducted. And for liabilities, so any loss made from the realization of assets and liabilities during the year, which we'll look at when we look at chargeable gains very soon. We're saying the losses required to be deducted above are losses from the realization of a capital asset of a business to the extent to which the asset is used in the production of income from the business. And then for a liability of a business to the extent to which, in the case of a liability that is a debt obligation, it is incurred in borrowing money, and that money is used, or an asset is purchased with that money, and that asset is used in producing income from the business, and that liability is wholly, exclusively, and necessarily incurred in the production of income from the business. And also, a capital asset of an investment to the extent to which it is used wholly, exclusively, and necessarily incurred. All we are saying is, if you make a loss from selling or realizing any asset or liability, you are allowed to deduct that loss in arriving at your income, a very simplistic level. But it must relate to something called a capital asset. What is a capital asset? A capital asset is any asset to the extent to which it's employed in a business or investment, but it's not any trading stock or depreciable asset. So take out depreciable assets. Take out all assets that can be put into class 1, class 2, class 3, class 4, class 5, and the capital allowance. Take out trading stock. If you have any other asset that is employed in a business or investment, then that is a capital asset. This is arguably the easiest way to define what a capital asset is. Now let's look at another important principle, which is the limit on deduction of financial costs. The law says that the amount of financial cost other than interest, the amount of financial cost excluding interest, right? Remember, we already dealt with interest already, so this doesn't cover interest. That is deducted in calculating the income of a person from an investment or a business conducted for a year of assessment shall not exceed the sum of two things. Please take note of this. It's very important. It's been tested how many times so far? A lot, because they know it's quite some way. The limit shall not exceed the sum of two things. 1. Any financial gain derived by that person that is to be included in calculating the income of that person from the investment or business for the year. So that is element 1, financial gain. And the next one, 50% of the chargeable income of the person for the year from the business or investment, which has been calculated without including any financial gain derived by the person or deducting a financial cost incurred by the person. What does this mean? It looks some way on the face of it, but at a very fundamental level, we are saying that the amount of financial cost that you can deduct during the year, financial cost that is not interest, right, cannot exceed a certain limit. So we are giving you a cap. Same way when we were talking about repairs and improvement, we said that repair and improvement amount cannot exceed 5% of the written down value of the pool at the end of the year. Here too, we are saying that when it comes to financial cost, the amount you can deduct cannot exceed the sum of two things. Makes sense, right? So let's even create an equation. The first component that has to be used is the financial gain that is derived by the person in the conduct of the business. So the first part is a financial gain. Then the B part will be half of the chargeable income of the person, which has been computed without including any financial gain or deducting a financial cost. So let me take that one more time. You pick the financial gain and you add it to half of your chargeable income, which is 50% for the year, which has been computed without including any financial gain or deducting a financial cost. Let me create an equation for you for simplicity purposes. So we are saying, you can write this down, limit equals financial gain. So you can say limit equals FG, which is financial gain, plus 50% of chargeable income star, or limit equals FG, financial gain, plus CI asterisk, where CI means chargeable income. I didn't write it on the screen because I don't want to create a formulaic approach. It is law we are studying, but let's use the formula for those who want to conceptualize it. So limit equals FG, which is financial gain, plus 50% times CI star. So CI star is chargeable income star. So now let's define CI star. CI star, which is chargeable income adjusted or modified, equals CI, which is your normal chargeable income. And remember, the law says chargeable income computed without including a financial gain or without deducting a financial cost. So what we do, we will add back the financial cost and we will deduct financial gain. Because remember, to arrive at any element that already includes an income or expense, what do? You add back the expense and you deduct the income. So CI star will equal CI, which is your normal chargeable income, minus what? Minus FG plus FC, where FG is financial gain, FC is financial cost. Let me take that again. Limit equals FG plus 50% times CI star, or limit equals FG plus 0.5 CI star, where 0.5 is 50%. So limit equals FG plus 0.5 CI star, where CI star equals CI, which is the everyday chargeable income. So CI star equals CI minus FG plus FC. So let's define where FG is financial gain, FC is financial cost. So hopefully this should help you conceptualize, those who like to create a formula out of everything. We are saying, because of the limits, any financial cost for which a deduction is denied may be carried forward in the order in which is incurred and treated as incurred during any of the following 5 years of assessment, but to the extent of what? Any unused limitation above for the year. So we are saying that because of the limits, if you have any financial cost that didn't meet the threshold, or any financial cost that exceeded the threshold, we'll only grant you a deduction for the threshold. Then the excess you can carry forward for the next 5 years and deduct subsequently in subsequent years of assessment. We are saying that a financial cost which is carried forward shall be used in the order in which is what is incurred. So obviously, year 1 cost will be carried forward and incurred before the year 2 ones in that particular order. Then we are saying the minister may make legislative instruments to prescribe the circumstances under which a financial instrument may be set off against any gain on a financial instrument. So it's very important to remember this for financial costs. Very, very important. So let's look at something that the income tax regulations, LI 2244, says about financial costs. Nothing serious here, but it just provides additional clarity that when the law in section 16 mentioned income, they are referring to chargeable income, right? So let's just note that from the income tax regulation. So at this point, let's look at a few more concepts. We'll look at things like losses from business or investment and how you can carry forward those into subsequent periods and all of that. That will be an essential element in the determination of business income in subsequent years. So for now, before we move on to the next video, just know that businesses can carry forward unrelieved losses into subsequent or into future tax periods. Let's pause for now and we'll continue in the next video. As usual, please don't forget to smash the like button and share this video within your networks. I'll catch you shortly.